I want to welcome everybody back for the last session of the day, where we'll be discussing the Federal Reserve programs in response to the COVID-19 crisis. The paper is by Arvind Krishnamurthy and Marcus Brunemeyer on corporate debt overhang and credit policy, and Arvind is presenting.
Thank you, Jan and Jim, for including this paper on the program and what's been a terrific conference so far. This is joint work with Marcus, and the topic here is credit policy in the current recession. So in the last recession, credit problems really lay in the financial and household sectors. In the current dimension, the current recession, the new dimension is really credit problems in the corporate sector. We come into this recession after really a decade-long increase in corporate leverage. And to a large extent, the government programs, the Fed, Treasury, corporate bond purchase programs, the Main Street lending programs recognize this. They've really been about dealing with credit problems in the corporate sector and Main Street rather really than Wall Street. The second important difference between the present recession and the last recession is that the policy objective last time was really about stimulus. It was about expanding credit supply and stimulating household spending. Whereas this time around, the way we are thinking about policy objective is it's more about insurance. It's about insuring against preventing economic damage and scarring that may occur during this pandemic, so that once the pandemic is passed, a recovery can be quick. So I'm going to start by just taking you through some data to give you a sense of the credit problems in the firm sector. And what my next two slides do is they present some data on corporate bond spreads. You should think of corporate bond spreads as the product of the probability of default of a company on its debt times the risk premium or the market price on default risk. So on the left panel here, I'm tracing through spreads on high yield, that is junk bonds, and investment grade bonds since the beginning of the year. And the spike in spreads right here in March is particularly noticeable. There's considerable evidence that in March, asset markets were dislocated, there were illiquidity problems, reductions in risk-bearing capacity that were really pushing up spreads in this period. And so when you think particularly about the March period, you should think of some of the spread behavior there as not just a rise in the probability of default, but also importantly, a large rise in the risk premium of default risk. That played out quite significantly in this period. Now, the Fed has done a very effective job in restoring market function. That is, the Fed's policy moves in March and April, which really drew from the 2008 playbook of lending facilities and asset purchase programs, have restored market function and brought risk prices, the risk premium and default risk, down to normal levels really by mid to late April. And we say a bit more about that in the paper, and I know Ben is going to talk more about that in his discussion, but I'm not going to focus on that in my limited time here. What I do want to emphasize is that by now, in June, spreads are elevated relative to the start of the year, and you should understand these elevated spreads as largely a reflection of the probability of default. Risk prices now on default risk are relatively normalized, so this is really about probability of default. Okay. Why are spreads high? Well, it's really two things. One is, as I mentioned, firms come into this period with high levels of debt. And second, this recession has had very differential effects across the board in the cross-section of firms across industries. The left panel, which is which is tracking junk and investment grade, give you a sense as to the debt effects, more debt here and less debt here. On the right panel, I'm plotting how spreads have evolved since the beginning of the year across different industries. And you can see that the industries in which our earnings problems are most severe, consumer discretionary energy sectors, are the ones in which spreads have risen the most. The next graph here on the left makes this point in a broader way. So what we're plotting here is spreads, a histogram of spreads across the entire traded corporate bond space. Okay, the blue histogram is the pre-pandemic histogram, and the orange histogram is the change, is the pandemic histogram. Okay, so what you see when comparing blue to orange is pre-pandemic spreads were relatively low and relatively tight. There wasn't much dispersion in spreads, whereas in the pandemic, what's happened is the level of spreads have shifted out, but just as significantly, if not more significantly, there's a lot more dispersion in spreads. There's just a lot more mass here on the right tail. And what that's indicating is there's just a lot more firms that are much closer to financial distress as we've gone through this. On the right panel, I'm plotting here bankruptcy rates. This is a monthly count of large corporate bankruptcies. And as you would expect, as we've gone through this and as more and more firms have fallen into distress, bankruptcy counts have risen. Now, this bankruptcy count is as of earlier this month. I would fully expect, given the spread behavior, that these bankruptcy counts are going to continue to rise. And noticeably, they're going to rise probably as high, if not higher, than where they were in the global financial crisis. The data I've just taken you through is data from large firms. It's likely that these issues are present and more severe in the SME sector. And for the rest of the analysis, I'm going to go through assuming that that is true. So this paper, as I said, is really about credit policy. It's trying to understand credit policy. And if you want to understand credit policy, what you need to understand is corporate finance. So we need to understand how existing debt affects corporate finance. If you were in a world in which debt is lower, if you're thinking about a company, say an investment grade company for which debt is very low, subsidizing credit really doesn't have much of an effect because roughly speaking, this firm will comply to Modigliani-Miller and really only the path of the policy rate will matter for economic outcomes. So if you want to understand how credit policy will affect firms in a beneficial way, you need to take a stand on how debt is interacting with corporate finance. And there's really two salient dimensions here that we need to pay attention to. One is the nature of bankruptcy costs. So debt may lead to bankruptcy and liquidation, which can cause scarring. How severe is this concern? Which sectors is it most apparent? Second, a high debt can be a drag on firm operations. And so we need to, again, think through corporate finance to understand what is the nature of this drag. And that's what we're going to try to do in the next couple of slides. So the policy question, which we're going to evaluate is, I'm going to just think about a hypothetical policy in which we can drop $1 into a firm. And then we're going to ask the question, where should the subsidy go in order to maximize macro benefits? And I'm going to take you through two cases. One is a case of a large corporate run by management in the interest of outside equity holders. This could be a large publicly traded company. It could be a large private equity-backed company. Both would comply according to my assumptions here. The issue for this firm, as I will explain, is one of solvency and debt overhang. And in distress, this firm is going to file for a Chapter 11 reorganization. The second case is of a small owner-run firm. As I'll make clear, the issue for this case will be one of liquidity constraints in the firm sector. And in distress, this firm is going to file for Chapter 7 liquidation. So what I want to do is just take you through an analysis of both of these cases. And I'm going to start by taking you through the SME liquidity constraint case in reverse order, because I think it's fairly easy and it'll be familiar for most of you to understand. So think of a small firm where the owner has pledged his personal assets as well as any collateral from the business for a bank loan. We hit the recession, earnings falls, and now this firm has debt service problems. The owner has no more personal funds to contribute, so he's put in all of his personal assets already. So liquidity is a problem. That's the scarcity in this case. So what the owner will do is prioritize his earnings, his cash, towards debt service, and in the process cut expenditures on labor and capital. So this means that there's a flow drag from debt. The liquidity constraint is causing the owner to prioritize his liquidity towards debt service rather than maintaining enterprise value. And then over time, what will happen is that the enterprise value will erode in this process. If this goes on for long enough, in the end, the firm will fail, it'll be liquidated. And there's a scarring concern that enters with liquidation, which is that the owner's net worth will probably take a hit. So in many cases, if a Chapter 7 bankruptcy is filed and the owner has pledged his personal assets here, he'll file a personal bankruptcy as well. So the owner will exit the bankruptcy with low capital. And so even if the pandemic is passed, in order to scale up the operation to the level as it was pre-pandemic is going to be very hard because the owner is going to have low capital. So the policy solution is really to provide liquidity to alleviate the liquidity constraint. And there's a close analogy here for this SME sector to the high MPC households of the 2008 recession. And a lot of the loan design ideas follow on ideas in the last recession in household debt. So payment relief is really the key, longer repayment terms, loan subsidies. The second case that I want to talk about is the case of a large corporate. Okay, and this case is more nuanced than the first case. So think of a large corporate with high debt, which is facing a solvency problem. So the high debt will distort an investment decision. And the reason for this is the Myers debt overhang problem. The reason for this is if I have a high level of debt and the firm makes an expenditure, the return on that expenditure partly goes towards the debt holders. So if the firm is being run in the interests of deep-pocketed outside equity holders, what the firm will do is it will underinvest. It won't take expenditures that maintain enterprise value. So it will not maintain a labor force or capex or maintenance because that ends up just improving value that in part goes to debt holders. So the underinvestment problem is also an erosion problem. Over time, the underinvestment erodes firm value. Now, again, if this goes on for long enough, if the solvency problem is severe enough, what can happen is the firm might file for a Chapter 11. And an important distinction between a Chapter 11 filing for a large corporate and a Chapter 7 filing for a small firm is that the Chapter 11 filing really can eliminate the debt overhang problem, right? So in a Chapter 11 filing, there's an automatic stay that comes into effect on payments to debt holders. That's quite useful in a situation of low earnings. Second, control is shifted from equity holders to the creditors, and the creditors can restructure the firms, and they will in a renegotiation in a manner that preserves firm viability. So they'll restructure their debts to get out of the debt overhang problem. Okay. Now, bankruptcy does have costs. It has direct costs such as legal and financial costs, and indirect costs which are spillovers to other stakeholders. I'm going to come back to those costs. Let me talk about the corporate decision to file. So as I've just talked you through, the Chapter 11 process is a way in which a large corporate can get over the drag from high debt. So let's just think through how a firm might file for Chapter 11. And for the sake of argument, I'm going to take a case where there are no direct or indirect costs of bankruptcy. Okay. Now, the key point to note here is the decision to file for a Chapter 11 bankruptcy is in the hands of the equity holder. And for a deep-pocketed equity owner, you can understand the filing decision using option intuition. So the equity holder has a call option and the enterprise, and you can think of the way the equity holder is running the business as in order to retain the call option, the equity holder must make the debt service payment. So you make the debt service payment in order to retain the call option. And what that suggests is as long as the option is sufficiently valuable, the equity holder is going to retain the option and make the payment. So how will that happen? Well, if volatility is high and if the option is not too far to the money, then the equity holder will continue to service debt and not declare a Chapter 11. Now, the key point to notice from my logic here is that this decision to file is based on option valuation logic and not bankruptcy cost considerations. Whereas from a social perspective, it's all about bankruptcy costs. That means that in this case, with zero bankruptcy costs, generically what will happen is the firm will file too late. It'll let the firm value erode, the debt overhang problem. And basically, it's a classic zombie firm problem. So take that now, and let's think about the problem of a credit subsidy to a large corporate. If the pandemic is expected to last a long period, or if bankruptcy costs are low, then optimal policy doesn't subsidize credit. Really, such a policy is misguided because it simply prolongs the problem and enables zombie firms. On the other hand, if the recession is short or bankruptcy costs are high, then policy can beneficially subsidize credit. So the issue for the large firm is more nuanced than the issue for the small firm. So currently, the Fed's assessment is of a long road to recovery, and I'm inferring this in part because the Fed's decision to keep interest rates low for the next 2 years, which they have made clear in multiple announcements, is a statement that we're expecting low levels of activity for considerable periods. And if that's the case, then what seems like the relevant scenario is the first scenario of a long pandemic. And in that case, the right policy is really not to subsidize credit to large companies. What that means is that the corporate bond program that the Fed has doesn't really need to be turned on. Now, the Fed is currently scaling this up. It's still not very big. Our analysis suggests that the right thing to do is to just keep it on standby and really to just leave it in the event of a market dislocation like the March 2020 period. Okay. Let me just turn to bankruptcy costs. So I have made the argument for large firms that it's not clear whether or not to subsidize credit to firms. On the other hand, policies that reduce bankruptcy costs are unambiguously beneficial. And moreover, they actually interact with the credit subsidy program, because if you are able to reduce bankruptcy costs, that means that you can provide less of a credit subsidy to a large corporate. So in the paper, we outline a plan to offer subsidized debtor in possession financing to firms that file for Chapter 11. And that's useful really for two reasons. One is it reduces the direct financial cost of a bankruptcy and therefore subsidizes debt restructuring. And the second reason is because, as I said, by doing so, you're reducing bankruptcy costs. And so you need provide a smaller subsidy to a distressed firm to keep it alive. The second aspect of bankruptcy costs are spillover costs. And perhaps the most worrisome on this front is spillovers to the financial sector. So distressed bankruptcy losses will eventually hit bank capital. We don't have a 2008 style financial crisis now, but that is a scenario that needs to be considered. It seems to us to make sense for the Fed to proactively basically shore up bank balance sheets, for example, by triggering the countercyclical capital buffer. Have banks issue equity now. Risk premium, market prices of risk are quite low now. Markets seem to be operating smoothly. This seems like a good place to also act to ensure. So I'm going to conclude here just to reiterate the main conclusions from our analysis. For financially distressed SMEs, the corporate finance problem is really one of liquidity constraints. The situation is very similar to the high MPC underwater households of the last recession, and policy should provide liquidity to these firms. For financially distressed large corporates, the situation is one of solvency and debt overhang. In our read of the data, we don't think a credit subsidy is warranted. The corporate bond program, which the Fed seems to be legging into currently, in our opinion, is best left on standby. And for the Fed to explicitly clarify to the market that it is a standby program to deal with something like a March 2020 dislocation. On the other hand, a targeted policy of reducing bankruptcy costs is unambiguously beneficial, and shoring up bank balance sheets to reduce indirect bankruptcy costs also seems wise at this point. I'm going to stop there. Thank you very much.
Thank you, Arvind. The discussant is Ben Bernanke.
Hi. Okay, we got this picture up. So very interesting and insightful paper. I'm going to discuss it, but in the broader context of the Fed's recent financial market interventions outside of monetary policy. I'm not going to be talking about monetary policy. So building on the legacy of the 2008 crisis, the Fed has gone beyond classic lender of last resort actions to take new types of stabilizing actions. I want to be clear that I think that these actions are justified and appropriate given the state of the economy. And I also want to commend the Fed on its proactive and rapid response. But there's an awful lot to learn about these new types of interventions and how they're going to change the Fed's capacity and the Fed's role, and how other central banks also will be using these types of tools. So let me talk again about Fed financial interventions other than monetary policy. Next slide. So there are three types of interventions that the Fed's engaged in. The second one is the one you're all familiar with, the classic lender of last resort, lend freely at a penalty rate to financial institutions to avoid loss of liquidity. That's Walter Bagehot from the 19th century. That's the classic financial intervention. But there's two others worth mentioning now. The first I call the market maker of last resort. I'll explain what that means. And the third is backstopping credit markets. Next slide. So a market maker of last resort is the buyer of last resort when limits on capital or risk tolerance in the private sector inhibit normal market making or arbitrage by private actors. And a couple of examples from recent period are the repo market spikes in September of 2019, when shortages of capital, balance sheet space, et cetera, led to these failures of arbitrage in the repo market. The Fed has been putting large amounts of cash in the system to try to offset that with a good bit of success. The other example I'll come back to, which Arvind mentioned, is the spike in March 2020 in the Treasury market, again, related to failures of arbitrage or failures of market making, dealers with inadequate capital to absorb the sales of treasuries by leverage-constrained investors. Next slide. The second type of intervention is the classic Bagehot type intervention, lending freely against collateral to financial institutions. The examples are familiar ones. Two of them require 13.3. The biggest one by far is the currency swaps, where the Fed is putting dollars into the global system. That a number of foreign banking organizations which do lend in the United States, but also elsewhere in dollars, have been short dollars because of loss of deposits, and also because of firms, their borrowers taking down large amounts of their credit lines. So these currency swaps, which have been heavily utilized, have been providing that kind of last resort type of support. Next slide. The third and relatively novel intervention is backstopping credit markets, where the difference between this and traditional lender of last resort is that the central bank stands ready to lend directly to ultimate borrowers, to corporations. And the authors talk about this as kind of if it's like a form of QE that lowers cost of borrowing. I don't think of it that way. I think that the backstop that's being offered by central banks, the idea is basically to cut off the left tail or to eliminate bad equilibria, which makes private lenders comfortable about re-entering, or if they're not willing to re-enter, then provide credit directly. So this can actually work without any actual lending. And the case in point is Draghi's do what it takes, when the associated program, the outright monetary transactions, seem to solve the sovereign debt problem without ever actually buying a dollar. So basically, the promise, the commitment to eliminate the bad equilibrium can make credit markets work better. Why is the Fed doing this instead of the Treasury? Well, some of it is just congressional CBO accounting, but there are elements of Fed expertise, connection to banks and markets, and its nonpartisan status that make it a good candidate for managing these emergency credit markets. And here are the examples, the facilities that you're all familiar with at the bottom. Next page. So I just wanted to give you a quick sense of the size, the magnitudes of these different activities. This page has the changes in the Fed's balance sheet over the last year, which are not associated with Treasury backstops. The next page we'll get to in a minute has the Treasury backstop programs. The first three of these programs, Treasury securities, MBS, repurchase agreements, are what I call the market maker of last resort. That's $2.5 trillion. That is where the money, that's real money. That's where the real money is. The remaining four items, most importantly, the liquidity swaps, are the lender of last resort activities. That's about $0.5 trillion. Next page, please. Here are the Treasury-backed programs. I count the money market facility as a lender of last resort activity because it helped prevent a run on money markets. So the entire lending on Treasury-backed special programs is at this point only about $12 billion. So it's actually very small at this point. For corporate credit facilities, that's probably okay. I agree with, in a way, I agree with Arvind and Marcus that this doesn't need to be big as long as it's there. And that will be, it has succeeded in making the corporate bond market work pretty normally. Main Street facility, as of a week ago, was at zero, and that is a concern both politically and also in terms of getting liquidity to the firms that need it. Next slide. So what's the assessment? Market maker of last resort, as Arvid and Marcus point out, that there was a financial crisis in March, with the Fed successfully calmed down. Next slide. Here's a picture. They look at stock market risk premia. This was really more about a bond. This was more a bond issue than a stock issue. So here's a couple of alternative indicators. One of them is the Gilchrist-Zatracek excess bond premium, which is a default adjusted measure of the premium that investors charge to hold corporate bonds. You can see the big shock in 2008 and a moderate shock in 2020, which is partly reversed. And then there's also the St. Louis Fed Financial Stress Index, which uses a lot of bond indicators as well. So there really was a financial shock. The Fed successfully intervened by standing ready to buy treasuries, MBS, CMBS, and doing repo operations in large scale. And this is an innovation, much bigger scale than we did in 2008. Next slide. The classic lender of last resort activity has not been as big a deal this time as it was in 2008, but it has been successful where used. It did release some stress on money market mutual funds and provided dollars globally to try to, again, reduce the stress on foreign banks that rely on dollar credit. Next slide. Now let me turn now to what Arvind was mostly talking about, which is the credit backstops for large and small firms, and starting with large firms. So as I've mentioned, the announcement effects have restored the investment grade corporate market to pretty normal conditions. And so then the question is this enough is this all we have to do? Are large firms now okay? And can we just leave the situation as it is? So I agree with their analysis, but I have a somewhat different view of the empirical elements. For reasons that are listed there, I won't get into. I think bankruptcy costs are actually fairly large. Won't get into it, but there are substantial both direct and indirect costs of a big firm going into bankruptcy. It's true that the recession is expected to last a long time, but the pandemic element itself and the economic implications are very uncertain. It could be that in 6 months we have a vaccine and we're back to flying and going to movies and doing all those things again. It could be that those things will never come back. So given that there's a lot of option value, given that bankruptcies I think are expensive, I guess I'm less comfortable than the authors are at forcing early bankruptcies among large firms. I think that it would incur costs before there's the clarity we need to know whether or not firms can stay in the current configuration. Next slide. So are there alternative strategies, to deal with large firms? And I'll just mention a couple which I think are interesting. One, which has been presented by Jeremy Stein and some co-authors, argues that instead of just lending and being a senior creditor, the government should be a venture capitalist of last resort, as Jeremy puts it, that the government should take a more subordinated position. For example, preferred stock plus warrants. That puts less cash flow pressure on companies in the short term, giving them a chance to determine their viability in exchange for some taxpayer upside. And that may be a better solution to the uncertainty that we face in the current situation. Andrew Metrick of Yale has another interesting idea. He notes that the pandemic risk is a pretty much undiversifiable exogenous risk to the system. He suggests that the government staple subsidized business interruption insurance to loans, which would be invoked if there's a shutdown or if there's biomedical indicators suggest that there's a second wave, then the government would pay the interest and principal on the loan. Otherwise, you would have normal lending relationships. And the benefit of that is it separates ordinary business risk from this undiversifiable pandemic risk. It may be a very efficient way to how to get firms through this period. Next slide. Now, the difficult case, and here I'm very much in line with the authors, the difficult case is for small and medium-sized SMEs. The bankruptcy costs are very high. Bankruptcy would often involve complete loss of the option value and of the franchise value of the firm. They mentioned scarring. I don't think in their paper they mention aggregate demand externalities, but that's an additional reason to worry about shutdowns of firms and layoffs of workers. So what we need here is a compromise where we assist short-term survival of small firms, while at the same time not creating zombie firms, allowing longer-term redeployment of resources. How do we do that? Now, it's not clear that the Main Street program, which is basically trying to normalize bank lending, is going to be enough to help those borrowers that are hard hit in the pandemic but have significant option value. So there might be some alternatives there. Let me give you a couple suggestions on the next slide. So how else could we lend to SMEs? An interesting alternative is what the ECB and the Bank of England and other central banks do, is what's called subsidized funding for lending. The ECB pays banks a percentage point to lend to qualified borrowers, and which is a little odd in a way, because you would think that Europe would have the bigger shortage, the greater shortage of bank capital, a shortage of bank balance sheet, and yet this seems to be, there's a lot of take up of this. So this is a very different approach than what we have here in the States, in that the ECB is just giving out money very cheaply if you lend to SMEs. It's not trying to do a dual underwriting the way the Main Street program is. A second possibility is just to make the Main Street program more generous. You could give banks an upfront fee to allow them to, to cover their underwriting costs. You could lower the cost to borrowers. That would be, of course, more expensive, but it might give the liquidity support to small businesses that they really need. This has been proposed by Bill English and Nellie Lang in a recent paper. And then finally, we, as economists, we generally think that lump sum transfers are the most efficient way to address these kinds of ex post risks. So the Paycheck Protection Program, tax credits for grants, would also be an alternative, which would be, the fiscal authority could apply to keep SMEs alive. So I just want to agree that the toughest of the three areas and the least familiar to the Fed is the credit backstopping. And the problems are quite different depending on whether you're looking at firms that can borrow in public markets and firms which are bank dependent or otherwise not able to access public markets. So let me turn to the next slide, which is the conclusions. I think people have not as fully recognized how much the Fed, and this does start in my regime in 2008, how far it's gone beyond classic Badgett. I think this is justified by the circumstances. Again, I'm not being critical, but we will need new doctrines and new thinking about how the central bank operates. And we'll have to ask the question whether or not these extra tools might help, for example, with the zero lower bound on interest rates and monetary policy as well. In terms of its application, in this particular episode, the Fed has so far succeeded, both as market maker and financial lender of last resort. It's also provided the backstop that has normalized investment-grade corporate bond markets. I still think there's some, and I think I agree with the authors, that there's still some tough questions about what's optimal in terms of preserving the continuation value of both large and small firms. My assessment, without much evidence, is that forcing large firm bankruptcies too quickly could be inefficient until there's at least somewhat more clarity about the course of the virus, whether a vaccine occurs, what the new economy is going to look like. I'm very much in agreement with them that SMEs need more help. Fiscal grants or concessional finance for a time to maintain their option value seems like the right strategy. Again, really interesting paper, and I'm glad to see such good economists working on what are some really tough problems of policy. Thanks.
Thank you, Ben. So we're going to open it up for discussion now. I think somebody has their mic open. And we have a hand up from Nellie Lang, and we'll take a few minutes of questions and go back to the authors. So Nellie, you are up first. Let me unmute you. There you go.
Okay, thank you. Arvin and Marcus, this was really an interesting paper, and the discussion of the costs of SME failures is so helpful and raises an awareness of why it is important to try to help those. The discussion, though, so I had a question about that. It felt like the SME issue is not so much size, but whether the firm is owned by somebody who's pledged all their personal assets, et cetera. In the Main Street program, they try to, I think about that in terms of firms with less debt. And I'm just wondering, like, and the Treasury puts it out there as like firm size by number of employees is the way to measure SMEs. But the economics of your program isn't really about the number of employees. So I was just wondering if you had an idea for better indicators of these firms for which some additional credit would be especially helpful.
Okay. The next question will be from Wendy Edelberg and then Raghu Rajan.
So, hi there. So Marcus and Arvind, when I read your paper, I interpreted, and maybe this was just through my own filter, but I interpreted thinking about the difference between bankruptcy with the large corporations versus the small corporations as who was taking the losses. So that with the large corporations, the equity holders and the debt holders could absorb the losses. I mean, this is all to say, I should back up and say, there are losses that will have to be taken. And there's a question as who's going to take them. So with the large corporations, you had you were putting forward an idea that the equity holders and the debt holders could take the losses. With the small and medium-sized corporations, I was a little surprised that, at least to the way I interpreted your idea, is that there were no losses that would be absorbed by those debt and equity holders. Like the owners of those businesses would not absorb the losses. And I was wondering if I interpreted that right, and why you thought they couldn't absorb any of them.
Okay. Raghu?
Sure. First, very, very nice paper. On the issue of large corporations, we sort of seem to think that the costs of bankruptcy will remain what they were. But of course, we're in different circumstances, right? We have a lot of viable enterprises which may be saddled with a lot of debt over the next few months because they're closed. But it makes sense for the current liability holders to restructure quite quickly. So I was wondering why you don't think that out-of-court restructurings or even the bankruptcy process will operate a little more efficiently than in the past and reduce the imputed costs of bankruptcy. In other words, won't the market adjust also? And if it doesn't, shouldn't that be where we put a lot more effort on making it easier to restructure, do out-of-court restructurings, which are blessed quickly?
Okay. The next question is from Shebnam.
Hi, it's a great paper, Arvind and Marcus. I would like to ask about SMEs. So it is true that we don't know that much about SME financing in the US, but we do know a lot in Europe. And the larger form of financing is going to be bank loans. The debt is going to be less in terms of corporate bonds. They have less of that. So that makes it no-brainer that you just close the liquidity shortfall and save all of them. It's just that how long you would do this, right? For example, we don't know exactly the number in terms of loans and debt in US, but we know the entire wage bill of SMEs in the United States is 13% of US GDP. So would it be, viable policy say, well, we cannot separate who is liquid, who is insolvent, so we'll just save all of them, or, it has to go through some sort of program that tries to separate those. So I just want to get your views on the SMEs, or SMEs should be just a blanket check. Thank you.
Okay. And next question from Annette Vissing-Jorgensen.
I actually had not asked a question. I don't know how it showed up as I had.
Okay. We'll put your hand back down again. So then let's go back to the authors. And when you probably, I don't know if you would frame it this way, but it was interesting the parallels between this discussion on the one earlier about reallocation of labor and zombie firms, and how is it a short run shock or a long run shock, and how much flexibility you can build in. And in particular, maybe you want to respond to Ben's points about alternative programs to the DIP financing proposal that you put forward.
Thanks a lot. Thanks a lot, Ben, for a great discussion, for outlining and classifying the various Fed policies in market maker of last resort. We totally agree with you that the Fed made a big difference in March 2020 to solve the market liquidity problems. And we also think the backstop is really about tail risk insurance and taking out multiple equilibrium problems. I think, as Janet pointed out, there is two future uncertainties. One is, how will the post-COVID world look like? And the social planner has some option value. So there's some value to keeping firms alive to some extent, that, because we don't know how the future world looks like. And the other uncertainty is about the length of the pandemic. And there's a big difference between the equity owners and the planners, because the equity owners, they would like to avoid the bankruptcy cost, and they want to keep the option value of the equity, which is like a call option. They want to keep it alive. And that leads to some distortions in their investment behavior and about their firing. They fire too much worker just to be focused on paying off the debt rather than restructuring. And I think the main message, or one of the main message of the paper, is essentially there's two classes of firms. One are SMEs, where restructuring is very, very costly. And, we have to do everything to bridge it over. But there are other group of firms where essentially the management is divorced from the equity holders to some extent. And Chapter 11 just means you replace one set of equity owners with another set of equity owners. And the distortions from the wrong investments are much bigger than the actual legal bankruptcy costs. I think that's the big thing. So coming to Jeremy's proposal and other proposals, I think that these are very interesting thoughts to keep the flexibility to the extent we don't know how the future will look like. And there's an option value the social planner want to keep, not just the equity owner, but we want to have the social planner on this other dimension. And one way to perhaps to implement it, the challenge is you have to price the warrant. So with this proposal comes, you have to price the warrant. That's very, very challenging. We don't know how to price this at this stage. And one way is to actually tax the firms later on with higher tax claims. Essentially, that's, you give them some grants today, but then there will be a higher tax burden on the firms later on. And this way, essentially, the government is an equity owner, because if they're do well, the firms, they have more profits and the tax burden will be higher too. So implicitly, the government is an equity owner in these firms, and that would be an easy way to implement, to keep the flexibility, and at the same time, you have essentially an equity stake. Just jumping briefly to the questions from Nelly, I think she very much said, the size is essentially just a proxy to what bucket of firms you fall into, whether it's easy restructuring or not easy restructuring or not. What matters a lot is whether the personal owner or the equity owners have a lot of other wealth. And if you have an SME and there's huge bankruptcy cost, they would have an incentive anyway to inject new equity. So that would be fair in these circumstances. So the problems would be less. So it's the big problem is if the equity owners who run the firms, entrepreneurs who run their firms, they don't have the wealth to inject equity. That's, I think, the bigger problem. Perhaps one way to classify it, look in the data, it would be another way would be to say how much additional resources, financial resources, do the main equity owners have in order to inject additional equity. Concerning Wendy's Edelberg's questions, who takes the losses? I think that's a big question as well. Here, again, I come to this Chapter 11, and we have this example in the paper where saying there's an old oil firm, and you just restructure essentially the liability side of the firm, and it just gets a new name, and nothing is actually changing in the firm. The management is the same, just the equity holders are wiped out, or there's some debt restructuring going on. And all what you want to do essentially is always to reduce the cost of the restructuring. So what we find, whatever you do, the cheapest way or the more efficiency you get, but just reducing the debt restructuring cost. And I agree with Sapnem, you can learn from Europe. And that's also going back to one of Ben's point, and where the ECB introduced this LTRO, targeted LTRO a system where essentially banks can borrow at a very, very low negative interest rates below the policy rate if they are actually pass this funding on to the banks. And Arvin and I, we have made an earlier proposal, it's also part of this paper, where we argue that the Fed should do the same thing to just help the SMEs to get funding and to give the banks an incentive for this. Of course, you want to complement this with banks who have a lot of equity in their banks, so the countercyclical buffer would help at the same time. So you can go even negative, essentially, if banks pass on the funding, but make sure that the equity stake is big enough. And that's why you want to switch on the countercyclical buffer now, where it's actually very easy to issue equity. The equity prices are very high. Let's make use of this possibility at the moment. And I leave Raghu's question, I think, Arvind.
Just to respond to Raghu's comment, I think, from our analysis, some issues about subsidizing credit, the answers are ambiguous, and it has to do with the reallocation point. We don't know how things are going to evolve. So credit subsidies are, the answer is ambiguous. On the other hand, subsidizing and reducing bankruptcy costs is unambiguously beneficial. If you had to decide where you want to drop a dollar, that's the place in which the marginal value is highest. And I think that, Raghu, as you say, it's working well. Maybe it can work even better. And if you want to spend, that's the place we would suggest you spend. So I'm going to stop there. Thank you for your comments. And thank you, Ben, for your discussion.
Okay. And thank all of the authors. This brings us to the end of the program. I'm going to thank all the writers of the papers and the discussants and everyone who participated in the discussion. There's also a large number of people whose faces never appeared on the screen who were crucial to the success of the conference. So Brookings supported adding a special edition at our request, and we're very grateful for that. And all of the people on the Brookings staff who have worked to bring this conference to fruition. It clearly would not have happened without them, and we're really grateful for all of their work. As was noted at the beginning of the day, this is only the beginning of a conversation on these issues. We have a long way to go. And there's much more to be said. Some of that will be said in September at our normal fall conference, which will be on September 24th. And we hope to see you there. So thanks for participating, and be well and stay safe. Hope to see you soon.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.